Thank you very much, Tim. And I couldn't ask for a better introduction that was not only more succinct, but I think really illuminates in some ways the challenge I think we're facing, both on a state level, so a sub-sovereign level, as well as a sovereign level. If I can maybe move to the first slide here. About 10 years ago, after the tsunami in Asia, our board of directors tried to struggle with the idea of here you have an event that is not only cataclysmic, is fundamental to those societies affected, and yet for our industry it was a non-event. In fact, our industry was irrelevant to the discussion around the impacts of the tsunami in Asia. And one of the conclusions they came to at the time was that when you have these very large catastrophic events, the burden of the disaster is not being borne by the private sector and the insurance industry, but really by the public sector. And what I'd like to do is fast forward now 10 years later to where we are in 2015. I think, and basically after that event, our board of directors set up my team, Global Partnerships, of which I head up the Americas region, which was only dedicated to closing that gap by working with public sector, that's state, federal, but also multilateral, to find ways for insurance to close that gap between insurance and economic losses. But fast forwarding 10 years, I think what we at Swiss Re have realized is that that discussion is equally relevant to industrialized countries and to industrialized sub-sovereigns, like what we have here in Florida, as it is to places in Asia or, for example, in Haiti. And this is a graph that we put together which looks at 3 snapshots, just to, again, put a little focus on the point, of 3 recent natural disaster events. The earthquake in Haiti in 2010, the earthquake in Chile also in 2010, and fast forwarding, the floods in Canada last year. And I think it's probably not a surprise to the people in the room, while maybe you see on the least developed countries a massive gap between insurance and economic losses, you have that same challenge in industrialized markets. And while the insurance coverage is much more, I think as Tim points out, there's still this very large gap that's going uncovered. And the other point I'd make is that when we talk about how these economic losses are covered in our industrialized markets, we're not only talking about insurance proceeds, but also a large chunk that's picked up by federal programs like the NFIP or FEMA. And again, I think here the question we have to ask ourselves is this the most efficient way for taxpayers' money to be used when, for the insurance industry, these events are, while I'd hardly say predictable, are certainly ones that we're modeling and very conscious of. And what I've learned in the discourse with the public sector is that not only are they looking to us for bringing capital to address this gap, but more fundamentally to bring to this discussion a rigor that comes with insurance. And I appreciate the comments both of the Senator and Commissioner McCarthy and also of Maria on the issues of mitigation, because what insurance does is put a price tag on risk and then provides incentives for people to mitigate against that risk. Again, coming back to how are we looking at this issue right now, if you look at the way we're currently closing that gap, I'd say it's very ineffective, and it's probably, if you look on the left-hand side, instruments that none of us really want to contemplate. And I think as we come to election season, hopefully more of our officials will also contemplate this, that if you talk about tax increases or budget reallocation, these are hardly ways to win political campaigns. I think a much more effective mechanism is to talk about, A, what the private sector capital can do, but also more fundamentally, that rigor on how we can look at the entire risk spectrum. Because that in turn then, again, provides the incentives for the risk management. And what we're finding increasing at an international level, but even here in the US, is that people are paying attention to this message because they realize that insurance can very much be part of the solution. How does Swiss Re conceptually approach this space? Well, if we look at the way kind of the risk landscape and the exposures look, we think there's basically 3 ways of breaking it up. The first, and that's the primary focus of what my team does, is what we call macro insurance. So this is really looking at the state, again, whether you're talking about a municipality or all the way to the federal government, as a specific buyer with these uninsured exposures. And again, it's not just catastrophic risk, it's also sometimes high-frequency risk. So one of the common things we see is that when you talk about very small events like snowfall events in a particular city, those snowfall events are systematically destroying city budgets. I live in the Northeast, and every year, particularly if anyone from this room has grown up in Boston or has been to Boston, knows that city's budget was absolutely devastated last year by the exceptional snowfall. And the city is having to make some very difficult decisions on how it allocates its money. So again, these economic losses are not just catastrophic issues, they're also now what we'd call frequency issues. A second area that we're focusing on is the question of pooling. How do you create public frameworks that allow, whether it's municipalities or individuals, to join together and to buy in an aggregate way insurance protection? And again, coming back to the kind of incentives around whether you talk about flood insurance or earthquake insurance, how in that mechanism do you provide a runway for individuals to improve their risk and over time see that through better insurance pricing? And the last topic that's obviously highly relevant to the emerging markets, but to be honest, I think one that's starting to also get more attention here when we talk about how do we bridge challenges around income inequality in the United States, is this question of what I'd call microinsurance. And again, when we think about microinsurance internationally, we think about really low-income populations, but what I'm thinking about is really how do we create new insurance products that allow people who have very fundamental challenges on their wallet at the retail level to make sensible and simple decisions around insurance. And I think you've certainly seen this area grow rapidly in countries in Latin America and in Africa. But what I hear when I speak to insurance companies, whether life or P&C companies at a national level, is there's also interest into tapping into this market here in the US because there's clearly a demand and it's clearly people are being challenged to make their wallets stretch further. The last slide I'd like to leave you with is just an example, I think, on how, if you apply this story the right way, you can make a difference. This is a program we worked with Guy Carpenter called the Caribbean Catastrophic Risk Insurance Facility. And what it does is it basically pulls together 16 national governments in the Caribbean, and now it's been expanded to Central America. And each of these governments individually gets a type of insurance called parametric insurance, which basically pays on kind of a magnitude of the disaster. And why this is so relevant for these countries is, one, when these governments have major catastrophic events, and to my earlier comments, it's not just the extreme 1 in 50 or hurricanes or earthquakes, but also the kind of events that happen every 10, 15 years. They see a massive impact in their budget, which in turn spills over in their ability to deliver to their people, and thirdly spills over into their sovereign ratings. So what these governments did was get together under the auspices of the World Bank and set up this new entity that buys for them this parametric coverage, which pays sometimes in as little as 2 weeks after the hurricane or earthquake. And this allows them to get liquidity very quickly after an event. And I know, case in point, in the case of Haiti after the earthquake, I had a chance to meet the deputy finance minister a little while later. And it was a very powerful anecdote because he said, the insurance policy I got from the CRIF for earthquake gave me the money that I needed within a week of the earthquake to keep my police in the streets. And that's a very powerful value proposition that I think our industry can bring, which is not just, again, capital, but a rigor that allows our government officials to make smart decisions about where they allocate very finite resources. Thank you.